How do you account for inventory for an e-commerce store? Inventory is often one of your biggest purchases, and if not accounted for correctly, can actually really distort both your tax and your financial numbers in an e-commerce store. So firstly, obviously, what is inventory? Well, obviously, it's the stock, the things you buy to sell to somebody else. How is it accounted for? So inventory sits on your balance sheet until it's sold. When it's sold, it becomes part of what is known in the profit and loss as the cost of goods sold. So to put it simply, let's say you buy widgets, and you buy your widgets for $10 each, and you sell it for $20 each. What happens? When you buy the widgets, you give the supplier $10, and they give you the widgets, and you put them on your balance sheet as inventory. Some time passes, days, weeks, months, hopefully not years, and you then sell those widgets. And let's say you sell them for $20 each. Well, you've now got a sale for $20 in your profit and loss, and you take those widgets off your balance sheet and put them in your profit and loss through an expense line called cost of sales. And so you now have revenue of $20, cost of sales of $10, and gross profit of $10. Simple, really. Inventory accounting is also really critical for working out your margins. In this case, it's termed the gross margin. The gross margin is how much you make for every dollar of sale. So, for example, using our widgets again, if we sell our widgets for $20, and this time, let's say we buy them for 10, our gross margin is $10 profit over $20 gives us 50%. That's pretty healthy. Some e-commerce stores get as high as 80 or 90% in certain industries, and that's fantastic. You want your gross margin to be as high as possible. Things that impact the gross margin include cost of sales, shrinkage, that is destruction of stock before you can sell it, delivery costs, how much does it cost to get your stock into your warehouse or out the door again, and obsolescence. These are stock that you can't sell for some reason. So maybe it's got an expiry date. Maybe it just goes out of style, out of fashion. All these factors go into your stock cost. If you just expense stock as you bought it, you're going to get massive swings and roundabouts in your P&L. So let me give you an example here. Let's say we bought $1,000 worth of widgets on Monday and did our profit and loss on Monday. All we see is a big expense of $1,000. We haven't made any sales yet, and so what we find is this big expense. Let's say on Tuesday, we sell all the widgets, okay? Well, Tuesday's numbers look really good because we've got $2,000 worth of sales, but we've got no expenses next to those. And so it's only when you bring those two numbers together, the sales and the purchases, to get the right answer. And so if you take this out over a much longer period of time, let's say we bought the widgets in January, but we can't sell them till June. Maybe it's a seasonal thing. And so if you expense it on January, then your profit and loss looks pretty rubbish all the way through till June when you sell your stock. Okay, so you're matching here the sale versus the expense to give you the right number for your margins. That's critical to running any sort of e-commerce business. Your cost of sales includes costs. They call it landed costs is the technical term for it. This is things like shipping, freight, tariffs in certain countries, and other costs applied to getting the stock into the country. However, it does exclude sales and marketing expenses, advertising, e-commerce platform costs. None of these are actually included in the cost of sales. They're overheads, which is below that line. Inventory valuations also massively impact your tax. So it's really critical to get this right. There are 3 methods for calculating inventory, and you can pick a different method each year. Cost, or the cost price method, is literally just the cost, what you paid for the stock. The market selling value method uses the current value of the stock if it's sold in a normal course of business. And the replacement value method uses the cost to obtain an almost identical item that was available in the market on the last day of the income year. So what does this mean? It means you have the ability under tax law, quite legitimately, to pick what your cost of sales number will be for any given year for tax purposes. This is really, really important, especially if you've had, say, a good year or a bad year. You can actually make your tax number go up or down depending on the method you use. And there's a method you can choose year on year as well. The one other thing to remember for tax, and indeed this is just good inventory management, is at least an annual stock take. If you've got inventory worth more than $5,000 on your books, you have to have an annual stock take. What's a stock take? Well, simply that's going around and counting up all the various pieces of stock you've got and checking them off. So let's say we've got 10 green spades, 10 yellow spades, and 2 buckets, and that's what my ledger says, or what my stock system says. Do they actually exist? You might find you have 2 green spades instead. Okay, well, then you have to make adjustments to your stock. Things happen. Stock does break. They go missing sometimes. Sometimes you've delivered orders that weren't quite what the customer ordered. And so doing an annual stock take is not only required for tax reasons. It's also just good financial management and good inventory management as well. Finally, when you get beyond just a couple of lines of inventory, having a proper inventory management system is critical to actually making sure that everything works together. For example, Shopify has an inbuilt inventory management system. Xero has a fairly rudimentary one, and there are plenty of other systems out there that you can use. Spreadsheets will work to a point, but obviously run the risk of data corruption and this sort of thing. Inventory management is also really critical to cash flow. Okay, so there's several different problems here with inventory management. Too much stock means you've tied up cash in inventory you either may not be able to sell or might be sold at a much later date. And so that's cash in the business you've got to have to buy the inventory. Too little stock can often mean missed out sales. We've all looked at websites for businesses wanting to buy something only to find that black or brown or whatever size we wanted wasn't in stock anymore, and the sort of the frustration that comes with that. I, for one, will sort of just walk out and go. So making sure you have the right level of inventory and the right sizes and colours and shapes and places, etc., is also really critical as well. And that's why inventory management, regular stock takes, is critical. Forecasting inventory becomes quite important off the back of that. Last comment on inventory management, dropshipping. Okay, dropshipping can be a real boon if done correctly. The best thing about dropshipping is you don't have the inventory. You're not required to pay for it up front. That inventory control is done by somebody else. So what that means is you don't need as much working capital, cash up front to make your sales. Okay, and so you can focus purely on the selling part of things. Downside to dropshipping is quality control is one. Shipping lead times can be really quite long. For certain countries like the United States, for example, there are tariffs in place today. And most dropper shippers are coming out of China, so you might get whacked with tariffs on the way through. And finally, they usually won't do your own bespoke products. So if you're actually building products to sell to market, drop shippers, that's typically not something they would do. So just watch that one. Final word on places like Amazon. Again, fantastic business, does really, really well, can be a great help. And getting your product in the Amazon system opens your product up to a whole new market. However, cost. Watch the costs. Their fees and charges are relatively quite high, which means the value of your inventory, either the sales price has to be very, very high, or you've got to squeeze the margin and suffer the lower margins to access their network. So that's it. Inventory Management 101.